one more thing to start, and then we'll get going. All right, so I hit record. Thank you, Joel. Double record. And I guess I should tell people when we're live that this is being recorded. So this is being recorded. If you don't want to be recorded, hang up. We're gonna go ahead and get started. Well, fair number of people showed up. I didn't think I'd get more than 3 or 4 because the invited group was small. So there's 2 things we're going to accomplish this morning. One, I want to do my weekend market update and pick a stock to work up. Now I kind of know what stock I want to pick up, but we'll take a deeper look. I don't usually do my weekend market updates live, so the good news is I have people can ask questions and I can answer them. So if there are things that I go way too fast or you don't understand, um, or you want further explanation, this is a good time will be a good time to ask. The second part will not be shared on YouTube. The first part will. The second part, we're going to go through how I look at options. And of course, we got two pros with Mike and Stacy. So that makes me nervous to present, but I'll get over that. I'm kidding. I know what I know, and I know I don't know everything, so it doesn't bother me. So let's go ahead and get started. I will turn off my video wherever it went to. All right, so this will be the weekend market update. It was a crazy week. In fact, October was somewhat of a crazy month. I think I probably was up, although I'm not sure. I think I was volatile, and I think I ended up pretty close to flat. I will take a look at my after 3 quarters in the model account that I've been running this year and see where we're at, and it won't be much different. So we had a strong end of the week propelled by Amazon. Um, I owned Microsoft into earnings. I bought puts, and the nice thing about insurance is it prevents the big loss, but you pay a premium and you have a deductible. So even with the insurance, I still lost some money on Microsoft, but I would have lost a lot more had I not bought some puts. Will better seasonality lead us to new highs? We're going into the sweet spot of the year. But I remember, was it 2018, 2017, we had a sort of a bear market in the last quarter, and we didn't recover until the day after Christmas. So it's no guarantee that we're going to have a great November and December. And then what about these Hindenburg omens and the divergences? Will they trigger a sell-off? So this is great. First, Pat. So what I do on earnings, if I want to protect a position, since I'm in a call, and let's say Microsoft is trading at 540, since I'm in a call and my call's at 500, I don't have to protect anything below 500. So that's the good news. And the other thing is puts are expensive, right before earnings. So I have to be leery of that. So what I did is a 5-4. I've muted everybody. So a 540 put, and then I had a five. I did a broken wing butterfly. I did a 540, 520, 510. So I only got $10 of protection if we finish below 520. The date goes out to next Friday, and we're about, I think we're 517, 518. If we go out at if we if we if we end next week close to 520 or higher, so we're at 517 and 81 we closed. If we close above or at 520, I'll have $20 of protection. If we drop down, I mitigate my losses, but I don't prevent the losses. And the reason why I did it that way, which may have been smarter just to buy an open put, was because a put was so darn expensive. The 540 put that I bought was $16. And the 520s were 763. So the two 520s paid for all of the 540 except for a buck. And then I'm net long. I had to buy the one underneath where I'd have unlimited losses. And that cost me 477. So for $6, I have $20 max protection if we fall down to 520. And if we crater, I pick up $10 protection. So the $10 protection for $6, it's not a bad trade, but it won't protect me from a lot of pain. I didn't think we'd go much below 520, and I got another week to get back above there. So that's what I did on the Microsoft. And that's why we're doing this live, so you guys can ask questions. So again, it's November 1st. MarketMRIPro@gmail.com is my email. The Google group is called Top Down Trader. And MarketMRIPro.com is my um, new website, which needs a lot of work still. This is for educational purposes only. Any recommendations in the spirit of education, not investment advice. Um, I do this video to show how I do top-down analysis. Trading involves risk. You are solely responsible. I may own or intend to buy or sell any stock I talk about. Even if I say bad things about the stock, I can still buy it. And trading stocks and options should be considered risky. You should always consult with your financial advisor before making trades. Um, the daily market analysis pre-market for wealth charts I put up Monday morning. Typically, I do it late Friday night, so if that's what you're looking for, this is not it. My Google group is called Top Down Trader. The reason you join this is because I don't always post on YouTube. If I'm traveling with my wife, she doesn't let me talk at night, so there's no audio, so I just cut and paste and put things in the Top Down Trader what I think the market's going to do, and I give you discounts, and it's free, and I will be going back to Discord at some point. Um, I, this probably becomes more important to watch now as we go forward, and these are the ones that I like looking. I like looking at the inversion of the rate curve typically before it happens. And the reason is that once you invert and you go below the black line, this is the 10 minus 3 month, the 10 minus 2 year. These are short term ones, the ones I like to follow. The gray band represents a recession. And just because we haven't had a recession yet, the point of this is the recession occurs after recovery. So I still think we have a recession coming, and I would not be surprised if we see a recession next year in the second year of the presidential cycle. Those tariffs may come to bear. Maybe we get into stagflation, but I think we've got to be aware that that's a risk. Then I look down here, the B of A US high yield index option adjusted spread, and it spikes during times of recession. But if you notice, it may start to trend up before the recession occurs, but it really spikes during the recession. Money gets tough to borrow, and we're not even close to spiking here. So that's a good thing. And then this is the Philadelphia Fed Diffusion Index. If you look at when the recessions occur, we're always below minus 20. Now we flipped below minus 20 earlier in the year, but we hadn't had the yield curve fixed yet. Then we had it again when the yield curve was crossing back up. I think if we cross below minus 20 here, history going back to the 70s and above going back to the 80s would suggest that that could be when the recession comes. So I think recessions are important. We talked about it in West Palm. Um, and the reason why it's important is if a bear market might average 20 or 25% down during a decent economy, during a recession, a bear market may go 50% down and wipe out a lot of your savings. So I always pay attention to that for that reason. Oh, and by the way, last week we know the weather was horrible. The boat got scrubbed, but we had a nice dinner. And those of you who were internet only, I owe you a gift card, and no one sent me their address. So please send me your address, and I'll send you a gift card for Capital Grill. And I know that everybody's going to do it, but if they're there for those that want it. Of course, this week the weather is incredible. When I get done, I'm going out on the boat, but I can't fix the weather if it doesn't want to cooperate. News and earnings are important. So in the red arrows on the left-hand side are the Fed heads that are speaking this week, and we have a lot of them. And Think about what we heard from the Fed heads this week and what we learned about the Fed meeting. There is far from consensus about December. I think the market's already put into the market that we're going to get a rate cut. There, you know, Powell sort of sunk the enthusiasm post announcement on Wednesday when he twice told us not to count on having a cut in December, that it's far from set in stone. So I think that's a concern. The hard red lines on the right are some of the economic data, but frankly, the ones that matter are the dashed red lines. And unless, even if the government opens, I'm not sure they'll get caught up on the data right away. There's a lot of data elements we don't have. And data goes both ways. And you know, I know for many parts of our society, the economy is horrible right now. But are we feeling it? Is the investor class feeling it? My wife complains about the price of groceries, but I go and I get gas and it's less than $3 a gallon. I know that's because I'm in Florida and it's not the same in California or other places. Um, and so I remains to be seen. And surprises to the upside in inflation, or if the employment comes back stronger than expected, will change the narrative. So I think hearing what they say, you're going to hear things of I want two cuts to I don't want any cuts. So I think that could whipsaw. And then on the right hand side, the earnings. So when I asked for questions before the live meetings, a lot of folks asked me where I got this stuff. So for the Fred stuff, for the inflation, I just type in FRED in that Google and just pick any of them. All right. So first one that comes up, I usually go to Fred 10 minus 3, and then I can just bring it up here, hit max, and I've got that picture. If I want the 10 minus 2, I type Fred and then 10 minus 2. And the same thing, I'll pull it up right here. It's right there for me. If I want the diffusion, it's the Philadelphia, I'll go Fred, PH, and there it is. Comes right up there. And if I want the Bank of America, the credit tightness, Fred, BO, and it pops right up. So that's where I get those, where I get my new calendar. There's lots of places, Market Watch, and actually I think I have the link typically in the slide at the bottom. But I just go to Market Watch and go to their economic calendar, and to me it's fine. I actually like this one better, Econo Day. But the problem with Econo Days, and it's not a problem, Market Watch is updated right away. This is still showing October. So I need to wait till Sunday to see the Econo Day. Since I do my videos early, I go to Market Watch. And these are all free things. And where do I get the earnings whispers? I just go to Twitter and hopefully nothing nefarious will pop up, but I doubt it. And I type in earnings whispers and I look for it. I make sure it's the right date and I copy it. So all free places to get that information. Another huge week, I call these 3 or 4 weeks in a row earnings Lollapalooza, where there's a ton of earnings. And I've been saying this for 30 years. It's a judgment call to hold stocks over earnings dates. It's bad judgment not to know when your earnings date is scheduled. On Microsoft, I bought those at the money puts because I thought it would drop 3-4%. I didn't think it was going to drop as hard as it did. So it reduced the pain, but it wasn't great um, for me. I typically would buy them at the money. And if I'm really nervous, I shouldn't have bought a broken wing butterfly. I should have just bought puts, but it would have had to drop 16 bucks, 15, 16 bucks for me to even break even. And it's not a good trade. So I did the broken wing butterfly, which is how I like to play some of the earnings plays. Frankly, sometimes just so I feel like I'm participating, I'll take a stock that I don't own and I'll buy a broken wing butterfly to the upside. I'll buy a broken wing butterfly to the downside. I'll buy a couple of calls, a couple of contracts each way. And that way it's kind of fun. Um, during earnings, and then typically it's a break-even trade unless I get lucky and it moves a lot one direction, and then I sell the short stuff the other direction, take profits in the long direction, and it reverses and goes higher. But to me, it's sport, and I only do a couple of shares just for sport. I don't spend a lot of money. So that's something to pay attention to this week. I told you I'd show you the end of quarter. I'm off a day. I was up on Friday, as most of you probably were, so I don't think it would change one day. So the model portfolio, for those that weren't following that, I decided this year I'd actually show you how I did. And I started with 150,000. Actually, I started with 149. It's the same thing. I did put in 503. I forgot about the three. I had a margin call early on. Um, Not a big margin call, it was 3,000. And I'm up 670 on the year, which is 217% on an annualized basis. And you could see, like, I had a great January and February. Doesn't look as horrible now, but I went negative around until the market bottomed, and then it's been a nice run up. And then those that follow me know that on April 7th, I put out oh, messed up the slide, off the April 7th lows. I put out a video on April 7th saying the market has had a bottom. It's time to go long. And you could see it's off that bottom where I made all my money. So I would have gone from probably minus 100,000 in my account at the low to plus 731 on from that low up. This is just that 500,000. This is a curve. And then you could see it's over 400% off the lows. Ian used to put out a slide that said you could go up 100% plus in 20 days on strong markets. You can. The winds are at your back. He used to say you attack, and we had a gale force winds behind us off the lows, which is why I care so much about the market, because it's what happens off those lows that matter. And this was the slide here. And then one of the things that we did on Monday in West Palm Beach or Palm Beach Gardens is we put together a leaders list. And the reason I do the leaders list, or I could say you did the leaders list, is we wanted to put together between 15 and 25 stocks that were leading in the market. And we wanted them to, being extended is fine. It's not a buy list, it's a leaders list. And the intent is that no industry would have more than two stocks. The stocks would kind of look like this curve here. And then we would use this chart to watch and see if the market rolls over, because typically the leaders fall hard. Growth goes up like rockets, falls like rocks, and this index typically breaks before I want to be out of the market. It won't keep you out of a 3, 4, 5% pullback because, hey, we're going to get those all the time anyways. But if the bull ends, this will typically end before, and you could see we're at all-time highs on the leader index. That's good if you want to be long. So there are bullish markets, bullish arguments out there. And if you look at when the S&P 500 has been up 6 months in a row, so that would have ended October 31st, would have been 6 months in a row off of the April lows. And you look at where we are 1, 2, 3, 4, 5 in a year later, we are positive on average and up more than 2/3 or higher. In fact, when you look a year from now, and 9.65 may not seem like a giant number, but it's more than the average performance of the S&P, and it's up 81% of the time. So being up 6 months in a row says we're probably going higher. Now, the next 2 months, 1.42%, 62% of the time, that I think is probably less than what you would normally expect if you just look at seasonality of November and December. The other thing is if you looked at the NASDAQ 100, and I made a comment that it kind of looked like the gold chart with the multiple gaps up. And what happens after its intraday low was 0.3% above the Bollinger Band. And you could see that it's up 100% of the time 12 months from now at an average of 26.93. And again, it's up more often than not at all time frames. It's a 50-50 at 6 months, but even though it's 50-50, because of what we saw in 87 and 96 and 02, it was up still 4.29% at 6 months. So there's no guarantees in life, but you could certainly find reasons to be bullish. And then what about those Hindys? And this was it Neptune Substack published this. Ian's slide is on the right, and Ian's slide on the right, and I know it's hard to see. Um, Basically, 6 out of 23 of the Hindenburg omens between 85 and 2005 were 25% or more corrections, which means the average one is modest. I think Ranking had something about that today. I think he said like 6.7% or something for the 70% that are actually down. Well, if you look at all the omen signals that we've had since 2018, and a lot of these are one signal, like September 4th to September 21 is just one signal. So I personally would have looked at from the last signal, not put all of these here. But what the Hindenburg tells me is 1 week later, 2 week later, even a month or 2 months later, the market's typically down. And this is looking at modern times. And that if you look a year later, you've recovered. So short-term pullbacks happen. And so we've got this battle now. We got this battle between the perma bulls and the markets just keep going higher and it ignores bad news. And you saw the prior two slides that would say we're going higher. And then we got the Hindis. So what are my thoughts? News still matters sometimes. Powell talks down December cuts and the markets pull back. That same night, we have announced a 1 year truce in China tariffs. Imagine if this had come out a week after Liberation Day. The markets would have rallied. It was ignored. Earnings and CapEx, they matter sometimes. Google, Amazon, they did good. Meta, Microsoft, they sold off for the same reason. CapEx was too high, their AI spend. Now, CapEx is too high. Where's the money going? It's going to go to NVIDIA, which had a great week. Some of the money will go to NVIDIA. Apple failed to hold its earnings. Apple initially pulled back and then it popped after hours. And Kramer made fun of the people that sold Apple immediately after the announcements. Well, that big move failed to hold on Friday. And then triple plays are still being rewarded. You beat earnings, you beat revenue, and raise guidance. That's my favorite picture. Some stocks are still working, but it's narrowing. And I saw more breakout failures. So ERM, that was one of my holdings, and I should have not had options on something that's so lightly traded. And I did the chicken shit synthetic. So I had a short put spread, excuse me, a short put spread, yep, and a long call. So that's combined. And because of the wide bid and ask, it's been negative ever since I bought it. Again, volume matters on options. And then it popped on earnings, and I sold the short put spread for 20 cents, and then, of course, on Friday, the long call cratered. So I wiped out my profits, but because I covered that short put spread, I'll still make money or break even on the trade. Um, I cover shorts when they get to be cheap. And originally I tried getting 10 cents for it or buying it for 10 cents and nobody would sell it to me for 10 cents, but they sold me for 20 cents and let me buy it back so that I could get out of the short position. So breakout failures are increasing for me and that's worrisome. I think a quick pullback to the 50 is coming, but I don't think it's bad. I think it might actually be good. And man, if we could fire this week and drop 4%, how much is 4%? 3%. We'll hit those 50s. And I'm not saying it's happening, but I think it would be okay if it did. And that would give us a chance to pause and then run into year end. And then the short term overbought, oversold indicators, you'll see them. They're all closer to a bottom. And so I think we have enough warning signals here to be careful. Onto the charts next year in Florida. I'm also going to talk with my friends in Orange County and see if they want to pick a date. If you want to just get a sense of what date I'm going to look at for Orange County, it'll be June, and it will either be the weekend around, and this will be up to them, hopefully 5, 6, and 7, or 12, 13, and 14. And that's the cheap meeting. No food, no drinks, no frills, but 300 to 400 bucks for the meeting. All right. So into Market MRI Pro. I will tell you, because I think most of you, who are at least everybody on the call, have the program. I just got this morning. There's still some bugs in it, but it's the latest update. And once I get done with it, and we got a few more things to fix, Praveen will push it. There's some really nice things he added. Um, so the daily briefing, and what I do here is I rank it by 1 day close. And when you do that, just to show you, yours won't look as pretty. Um, but let's change it to 5 day change. And just to show you what, see how it just, the formatting just got screwed up. So somebody showed me on one of my videos, probably one of you, just go to best fit. Now I've asked Praveen to lock it into best fit position, but we haven't done that yet. So he watches these videos. So I just reminded him. So I look at what happened. Bitcoin finally bounced, was up 3.15. It was still down on the week, but it finished in the middle of its range. Interestingly, the indexes were up on Friday, and they rallied into the last couple of hours. The Russell was up 0.56, and you could see at the upper part of its range. Volatility was up a little bit, 0.5 on the week. It was up 278. Russell was down on the week. Qs were up 0.48. Qs were up 2% on the week, and they were the leader of the equities, and they were in the bottom third of their range. On Friday, the spiders were up 0.33, about 50-50 on their range, up 0.71 on the week. Dollar was up some on the week, and up 0.28 on Friday, and the diamonds were up 0.14, and on the week they were up 0.73. So except for the Russell, it was a pretty good 5 days. The Russell, maybe it needed to pause, has really been outperforming of late. Now, if you look at the new high, new lows on the NYSE and the NASDAQ, and I concentrate on the 12 weeks, you can see we're still minus on the NYSE and minus on the NASDAQ. You could see the number of new lows have increased to over 100 on the NASDAQ, 83 on the NYSE. So even though we had a mostly positive week, if you ignore the Russell, um, we're not strong on breadth. In fact, we're weak on breadth. And new highs on markets are not built on new lows on stocks. And I'll just say that. If we look at some of the breadth, we did improve on Friday. Remember, the colored is today, the gray is yesterday. So you could see sectors went from very few positive to 64% positive between Thursday and Friday. We're now up to 57% industry groups, and we broke the 50-50 mark with 54% of the stocks in the S&P 1500 up. Same thing, improvement in industries and sectors in the NASDAQ, 56% up. Same in the NYSE, but only 55% up. So although it was a strong day, considering it really wasn't, we didn't reverse the breadth issue. It's still 50-50. So that means a lot of stocks are still going down. If we look at the S&P 500 sectors, you could see the XLY discretionary led, and that's called Amazon. And if you look at what lagged, it was utilities, materials, staples, healthcare, real estate, kind of the weakest. And technology, even though on the 5 days, technology was the big winner, up 2.38, and the only thing else up over the week was discretionary. Technology was rather flat on Friday, so we saw that performance without tech really participating didn't hurt us. And as we faded some of the benefit of the earnings gap, you could see tech was down almost 1% from its open. Down here, you can see categories that are leading, and I always discount marijuana because they're cheap stocks and they move a lot percentage-wise, but not dollar-wise. Clean tech, solar, video games, genomics and biotech, Dow Jones Internet, cloud, blockchain, fintech, software, cybersecurity. So even though tech was weak, some of the software and the solar clean tech names were not. I mean, First Solar had a great day on Friday. So this always gives me a sense of what the market did. This is why I look at it, why I spend as much time as I did. And what lagged was uranium, which has been leading. So was there a pullback in data centers? Silver, lithium, this is why materials were weak. Gold, and then China, Norway, which is a heavy um, minerals economy. So that sets the bar. The timing brief, you'll notice one thing in the new update, which I think is great. It's a much bigger calendar, so you can actually see it. And you can pick any date, but when you're done, you just have to go back into this and hit today. It'll take you back to today. Um, in the weekly model, everything is still long, but when we look at the daily model, we lost the Russell this week. Now, in all reality, we closed just under the WMA 245.99, and we closed at 245.91 on the Russell. But the bongos are red, and the bongos are red on the spider as well. So I won't say that this is perfect, but we're still positive on the other ETFs. So predominantly higher is the suggestion here. And I'm not too worried about the Russell. The weekly says that we are in still okay to be long. And the monthly says the long-term trend is still your friend. Now, I started wondering, should we look intraday? And I'm not ready to start looking at this, but for shorter term traders, um, it gets you in and out very quickly on the intraday. And you could see we're red on all of them. So I'm going to watch that as the week goes by and see if I should add an hourly chart preview. And I'm just show them I'm looking at hourly on the timing model, and that I wonder if it's a value or not. So again, enough here to make me a little nervous because the Russell pulled. So maybe we're going to pull back in an uptrend, but I don't see doom and gloom. The guppy charts, which I don't look at all the time. I probably look at them when I wonder to be nervous or not. And I usually look at the weekly. And what I talked about, I think, in live, is I look for these to get underneath to be really bearish. I look for them to get into the moving averages to be concerned. And when it's a tough market, we'll start to see, as we saw in here, the moving averages start to roll over as well. The daily will react faster. So just curiosity, look at this in the daily. I don't know if it even works daily. So Praveen, we may want to turn that on to activate it for daily as well. But the reason it's not activated is because I usually look at it on the weekly. If I want to look at the index ETFs, I think we don't need to go through everyone in great detail, but let's just look at where we are in the spider. I mean, how beautiful is this market we've been in? V bottom on April 7th, maybe a little bit of a try to do a W, but we have essentially been in an uptrend since those lows. And when you look at the high jump, we've come off the 100%, but if you watched, I think on Wednesday's video, one of these videos I talked about here, we were at 100%, and we always come in a little bit after that 100%, and we were at 100% on the spider Qs and the diamonds. And I also commented you don't have to pull back, you can just go sideways, but we don't usually stay the most extended on the year for a very long period of time. You also can see the big gaps that we saw. Now, what if we start filling these gaps? Where are we going to end up? Well, that's the 17-day moving average would be if it got us down here. The 50 is down here, but let's just see the 50. No, it's time for glasses. Sure, the video's turned off. No, I'm just kidding. I'm not vain. I'm a guy. 662-ish is the 50. Oh yeah, it says it right there. So if I just look in the upper left-hand corner, we closed at 682. The 50 is 662. That means the 50 is 20 points away. Would a 3% pullback in the spider surprise anybody? Kill anybody? I would hope not. And why would we not get that? We got it here. We almost got it here. We pull back to the 50 here, pull back to free parking, and then run into from Thanksgiving into the new year into a big move up. That wouldn't hurt anybody, I think, unless people just sold everything. And you could see seasonality is our friend. So I look at this. We came off the top. We've had so many of these little pullbacks on this run, which are very normal. How much we pull back? Do we get below the 50? I doubt it. But I think that's how I see the spider. And remember, it's this little four arrow thing that makes a difference. Qs. Same thing. I just want to look at that analysis of the 50. Upper left, we closed at 629. The 50 is at 596. So that means it's at 29 plus 3, 32, 33 points. So what, we're 4 to 5 points away from the 50. Again, is that going to be the end of the bull? Absolutely not. Seasonality is good, which would argue against much of a pullback. If we look at the diamonds, same exact story. I'm not going to do the work, but you could see we had 100% on the high jump, pretty predictable, little bit of a pullback. You'll notice the red dots. I didn't show you on the others. It's just a red candle high. And we talk about that. It means we opened up higher than the highest high going back 20 candles, and we closed lower on the day, giving us a red candle. Why is the candle there not red? Because of the conventions we use. What I use in Market MRI Pro, and maybe we could make it customized, is I want an open candle, red or white, if the market closed higher than it opened. I want a white candle if we closed higher, and I want a red candle if we close down on the day. So a lot of people will use the did I open higher or close higher? If I opened higher and closed lower, that's a red candle. If I opened lower and closed higher, it's a white or a green candle. Just the convention that you use. Diamonds is the same story. It got the high jump triggered and it's come off the high jump strong seasonality. If we go and we look at the Russell, this one's a little different, a little different. We had a high jump probably trigger somewhere in here. I guess maybe we didn't get a high jump. So the high jump was all the way back there, and that's where we peaked. But it looks pretty clear to me that this 50 is could have been a target. Maybe it still will be a target. 246 down at 241. We're 2% away from the 50. All we need is a week open on Monday. We could hit the 50 on the Russell. But again, beautiful uptrend off the lows. Nothing nefarious. Looks like it's happening right now. Just a typical pullback. This one really turned around. This was the laggard for so long and really has done well. But could we pull back to the 50? Sure we can. Do I do anything about it? No. Volatility, markets are doing okay. We never came down to where we usually end up after the VIX fires. The VIX fired over here. Maybe that's bothersome. The VIX was up a little bit on Friday. And then one thing that's had a big move, and it's been supportive on the market, but I'm going to put big in italics, is the dollar. And the dollar broke out above the 200, which it really struggled with for many days. Now, why I don't know when to worry about this, but we're still really, really low. I mean, you could start looking at areas that you might expect. Does it run up to this gap fill? Well, it's already taken out this gap fill here. So is that the next target for it? Could be. Is it where we failed here? So we'll watch and see what the dollar goes. Um, Now I wish I was going back to Europe because of the dollar strengthens, although I'm going to India, so I'll get the advantage there. Um, but how far does that dollar go? Way off the highs, which mitigates some of the concerns. Why do I not like a rising dollar? Because not that I travel to Europe that often, but a lot of our stocks sell stuff in Europe and other places. A lot of the companies, and the dollar goes up, it makes things more expensive in the local currency. Um, Yeah, I mean, I think, Bazzi, that I think in a range, oscillating dollar down here probably doesn't matter, except for those of us that are shopping overseas. But a strong dollar hurts the multinationals. And so, you've got was a Kudlow that likes the strong dollar. You got, gosh, if I'm Trump, I like a weak dollar because it helps me sell goods overseas. I think it has depends on which picture you look at it, but certainly for commodity stocks and things that sell a lot of things overseas, um, a strong dollar is not great for those stocks from a commodities perspective. Now, I talked about how gold looked a lot like the NASDAQ with all these gaps. Now, gold looks like it's put a pivot in here, kind of at the top of one of that gaps, ups. But we'll see what gold does. It certainly looks to me like it's getting set up for another run. Um, but looking like it's set up for a run and running is a different thing. And I don't care what I'm looking at, but when I see 100% high jump, I get nervous. And this was the signal. You had 100% high jump here for quite some time. You had it here. You had the little pullback, and so ultimately, when the high jumps 100, things come back. Now, gold short term looks like maybe it's recovering, but I don't know if I would say it's trending yet. If anything, it's longer term, it's trending down. My gut is that gold probably starts to go higher. Silver, um, very similar to gold. Maybe it's had a little bit bigger bounce, but the same story. Um, the stocks don't like to be at 100 for long. And typically, when you get the 100, you get a pullback. And we got a pullback. Is silver broken? I don't think so. I think it's rallying off the range of the 50, the same as gold. A lot does depend on the dollar. One thing that's been weak, and it's funny, I've been asking myself, and I think I said on a webinar, why aren't we why are we not refilling our strategic reserve with oil down? Um, and I found out by listening to the Idiot Box this weekend or this week that China is refilling their strategic reserve. Oil's in a clear downtrend. So maybe Trump thinks he can get it cheaper. Natural gas, and maybe it's because we're switching to winter. Natural gas actually bounced. Natural gas to me isn't that exciting to play, and it's really, from the long side, it's not been good for a long time. But then you hear the same thing that told me about China and the reserve, that Europe, which gets most of their natural gas from much of their natural gas from Russia, and was planning on cutting that out in 27, at the end of 27, now says they're going to switch to other sources by the end of 26. Who do you think is the Saudi Arabia of natural gas? We are. So we might see gas prices go up. Still not buying it down here. And then I'm going to look at the 10-year and the 30-year to get a sense of, is there a problem? We ran up right into resistance. It'll be interesting to see if we break out or not. So we're off the lows on the 10-year. And even though they cut rates on Wednesday, Thursday, Friday, um, the long end of the curve went up. And that might not be a surprise. The long end is not what's controlled by the Fed. That's controlled by the bond market. And you have some, the vigilantes are, bond vigilantes may not like cuts because it might increase inflation, which is always bad for bonds. And this is the 30-year also up a little bit. Oh, that was a weird sound. Did somebody send me a text or something? Hmm. Okay. And then you could see here, you guys can still hear me, can't you? Just type a Y. Okay, good. I just had a weird sound in my headset. I wanted to make sure. So the 30 years are up. This is the 5% area. This is when I get nervous. It seems to be when the market gets nervous. It seems to be where we reverse. So maybe not a whole lot going on. Yeah, I keep getting a weird sound, but I don't see any messages popping up. So If you guys lose the audio, you're going to let me know because I'm watching the chat box for questions. So you'll let me know. All right. So next thing I'm going to look at is buckets. And I want to show you, I just love what Praveen did for us. Um, right now it's for me, but you'll get it in the next push. This is the buckets on Friday. And you could see the gray bar. And that gray bar says it was much higher on Thursday. So we shifted a little bit off of the bearish footprint. We have less stocks below the Bollinger Band, 14%, 17%, 9%, and 11%. So we're still mostly to the left, which means most of the stocks are in the lower part of their Bollinger Bands, but we got kind of off the excessive. Now, one thing you could do is you could open up the calendar and just look at what did it look like end of day on Thursday. You change the calendar, you got to flip that, and you're going to see those numbers should pop up in a second. And you can see that's what Thursday looked like. So clearly we changed going into Friday. What I really like is, why was I so adamant about April 7th being a bottom? Take a second because this is calculating. And you could see I really wasn't risking my reputation that bad. You had 76% were below the bands on the NYSE, 79, 52, and 66. That was a pretty impressive day showing an oversold condition. Now to get back, hit the calendar. I am so happy, Praveen, that I don't need my glasses to see it anymore. And I hit the today, and it doesn't happen immediately because it's calculating, but it will bring us back today momentarily. So that was a huge update that he did. All right. Right. There you go. There we're back to today. On market breadth, I don't. I hope to do the same thing with market breadth. The challenge with market breadth, and the reason why we have it only on dailies, are these devils down here. They use up a lot of data calculation, compute time, and we don't calculate back routinely 10 years, 15, 20 years. We'd have to push back the calc, and this is a slow workspace to open up because of those calculations. Very interesting. On the left is the NYSE. On the right is the NASDAQ. And maybe it is the tail of the markets we're in right now. The NYSE has sold off. It's dropped from a high of about 21,800 down to a low here of 21,350. So that's a 450 drop. Now, on 21,000, what is it, a couple percent? It's not a horrible drop. And one of the things I've asked Praveen to make for us is a measuring tool. So I do that and tell me exactly the percent and make me not have to do the math. Notice where it stopped, right at the 50. Where did it stop here? Right at the 50. Where did it stop here? Right at the 50. Um, Reparking, this is when it broke above it. The 50 will be resistance on the way down. You broke above it, and now becomes support. So you could be optimistic, especially on the broader markets. And maybe that's all we're going to have is a rotation into the broader market away from big cap tech. So I love this one. I love the fact that we've pulled into the 50 and the 50 has held multiple times. So the NYSE is down to the 50. Then you look here at the NASDAQ composite. It had a negative day on Friday. Remember, solid bar, it's closed below the open. Didn't have a negative day on Friday, rather it closed below the open. But since it's a white bar, it was up from those lows. It's still at the highs. How does that sit in my mind? I think it's got to do with the large cap techs, the mega caps that are holding it up. This is a much more attractive picture to me if I'm looking for a bounce. If I look down below, not that I don't trust um, market MRI data, but I've been using Market Surge or Market Smith to determine on the day high or low. We were 3% above the average on NASDAQ volume and 5% above on NYSE. So decent volume, but not excessive volume is how I'd look at it. You can see stocks above the moving averages are still trending lower. All right. You don't want to see that at tops. You could see new high, new lows were negative on both. AD lines were positive, but they were negative the prior three bars to a greater extent. Up down volume was positive, and we got another friend. We got another Hindenburg Omen signal. Interesting. When do the Hindenburg Omens become very meaningful to me? When I drop below the 50 is where all the action occurs. So we're still technically above the 50 here. We closed above it. Um, I've been around long enough to pay attention to Hindys. The fact that we've got Hindenburg Omens on two of the indexes really at the same time. This is something that does bother me right here. So I am not a perma bull and I'm not a perma bear. Um, and this is one of my favorite indicators. And and I think it's important to recognize that a week out, 2 weeks out, a month out, it does show some pullbacks. And that 2 months later, the markets are positive only 17% of the time. So I can't ignore that. And I am potentially missing out on some gains. Part of the reason why my um, portfolio was relatively flat in October is I've got more cash in my account than I've had in a long time. And now I will either quickly deploy if my hypothesis that we're going sideways or pulling back is proven wrong, or I'll deploy as soon as we pull back. But I'm sitting on a lot of cash right now, more cash than I invested in the market this year. The other market breadth tool, and I don't know the status if it's been pushed or not, um, you can see that the 13-week new high, new lows are 0.22, 0.19, 0.21, and 0.27. Those are all low, but are they a signal yet? So let's go into the calendar. Let's stress the system and let's go to April. Let's go to April 7th and see, and it's going to be in the middle. Now, I don't know if I want the dates to show up in the middle so I could see what happened, or I want them to show up on the right edge of the chart so I can then predict what happens later. Right now, they show up in the middle. And I guess this line here must be the date that we moved over, which is interesting because it's not in the spider. But you could see where they were at the lows. On the low, let's just highlight April 7th bar. 6. So 0.02, 0.02, 0.01, 0.01. So we can see we got a ways to go before we trigger. That's the only purpose that I did this for, is to show you that is what is going to trigger. Short-term bottom in here, and we got down to the same level. Market had a little bounce, doesn't, it's a short-term bottom. So great question. Let's go back to from Bazi. I just publicized your name, but sorry about that. What do I do at this point? And how do I manage with those Hindenburg omens? The reality is, and it's a great question, we get a lot of Hindis these days, a lot more perhaps than the old days. And that might be there's more volatility, who knows. We changed our NYSE a few weeks ago to take out all the things that don't behave like interest-bearing bond funds. And we started seeing a few more Hindis. I did that intentionally because I think that's more appropriate. A Hindi without a break below the 50, I'm likely to raise a little cash and be a little bit careful. A Hindi with a break below the 50, here's your Hindis. 2 in a row, you got to have a second one within 32 days to be confirmed. Here's your Hindis. Followed by a break below the 50 is when I start to liquidate. And since I'm predominantly long at the time, liquidation and raising cash is a protection method. When I see the Hindis, I'll look at option plays that have lots of cash, lots of upside, and decide, do I take my profits or do I buy a put? So what I commonly will do is, let's say I've made a lot of money on a trade in a long option, but as I'll discuss in part 2, which will not be published on YouTube, market makers screw you on options, and you never get out what the option's worth unless, well, frankly, unless you let it go to expiration and you get all the money that you're entitled to, but you might have a new position that you don't want on some of the spreads. So what I may do is, if I'm really concerned and I think the market's at risk and I don't want to take the cash out of an option trade because I don't like what the market makers are doing to me, I'll sell a put at the money. Excuse me, I'll buy a put at the money and sell a call. The call pays for most of the put. I've now guaranteed at expiration that put price at the minimum. The call, if I get called away, I get called away, but the call pays for that put and I'm protected for a sell-off. I don't need to protect the short call because I got stock. So you're right. You put on a synthetic put. Exactly. And then there are times, the break below the 200 perhaps, but you got to be careful because you see it move back up, where I might start looking at not buying puts on, not selling the puts, but buying puts on indices or some of the stocks. Notice what happened when this broke of the 200. We have 2 Eurekas in a row. So these were major buying days, bear market rallies. And that would have kept me out of put coverage. But this is what you want to avoid while you're long. I'll be the first to say I'm not the greatest at shorting stocks. It's just something stupid in my head. All right. I'm willing to take the risk of losing profits when I'm long. But I just get so afraid on the short side of this infinite losses. And it's probably because my stocks walk up the steps and my shorts, they take the escalator, and the stocks take the escalator down. But when you're short, it seems like they take the escalator up. And I don't, I'm not good at going short. My mind is a long thinking mind. To go back again, thank you, Praveen, um, for building this in. Typically, you would just have to go to today, but we don't have that yet, so I'm asking for it. But I know it's going to take a while because of this band on the bottom. Let's go back to this one. We don't have the Hindis and everything there, so we've got the new system set up. So let's go back to today, which we're at. So today is not neutral. It is not neutral. We are approaching reversal areas, which is interesting because I also think a short-term pullback is coming potentially, but we still have negative breadth. We set all-time highs this week, but nowhere close on AD lines on any of them, although maybe there's a little nubbin turning around. Nowhere close on stocks above the major moving averages. And then I showed you, just to show Praveen, I did go to an intraday timing, and I'm going to be studying it. I mean, you look at the charts, and I'm not a big guy for intraday timing of when I do my buys, but it's maybe something to watch. And now that I have the simple indicator here to buy sell that Praveen gave us, um, it is easy to see. So I have a question about, do I sell the call at the money or slightly out of the money to avoid a sharp pull up and then continue down? I hardly ever get my stocks called away by calls except at expiration. So I don't really worry about it getting called away if it goes up a bit. So I usually sell them at the money and buy a put at the money just so I have maximum protection. And I could certainly sell the position, but I'll look at how much the market makers are going to rate me to get out of the position. And they know exactly what I'm doing. I'm not the guy that is paranoid that if I put my stops in at the broker, the market makers are going to care about my 20 or 30 call position. I don't think that's the case. The issue is they know they have you by the kahunas, no pun intended, and that they just won't give you all the money you're entitled to. So I put all this together and I'm cautious. Still think we're going to end the year higher, but a short-term pullback wouldn't surprise me. What would make me get bearish? Um, I didn't mention it, but we had more bangos this week. Well, that was back then. Let me go back here. We had bangos on the strong on the NASDAQ this week. But if we started seeing some phoenixes up here, that would make me nervous. I don't expect a bingo to occur until I'm down here, but I would get nervous if I saw some phoenixes. Um, Again, if I had to predict worst case scenario, and I'm not in the predicting business, I'm in the thinking in advance, being prepared, and reacting to what we get. Um, I think that 17-day is my first target, and then the 50, and I don't really expect us to get below that. And what we showed you before, that's probably in the 4% range in a pullback at the 4 to 5%. So I am not bearish here. I am cautious here, but cautious enough to raise. Um, if I'm doing the synthetic put to protect a position that for whatever reason I don't want to sell, it's not taxes because it's options. It's a short-term position. I'm going to sell them at the money, um, and then um, just so I can get out. And how far away? If the next monthly is more than a week away or 2 weeks away, I'll just do it to the next monthly. All right, ratio charts. I love these things because it tells me that compared to the S&P 500, the only thing that's outperforming is technology, even with a little bit of a pullback this past week. I think saying it another way is I'd probably be better off right now than buying anything than just buying spiders or SPXL, a leveraged ETF. Why? Because all the sectors, including Bitcoin, which we know is not a sector, all these are ratio charts except for Bitcoin. They're all the S&P sectors are all underperforming the S&P 500 except for technology. The other thing I see here is that technology pulled back a little bit on Friday. Discretionary was the big winner here, which we said before is Amazon. The defensive plays are up off their bottom. Here is energy, it's off the bottom. Staples is bouncing off the bottom, not much. Real estate came up some. And then healthcare has been acting well. And it's defensive, but healthcare has been um, healthcare has been out of favor for a long time. This is a daily chart. So when you look at the daily ratios, it gives you a little bit different picture, but it's also going back to 23 versus the hourly, which is a much more shorter term look. And again, technology and communications over the next time frame have been the big leaders. So now I'm going to go into the JS layout, and I'm going to look to see if we can find something to go work up for part two, which is the options. So there's top down and there's bottoms up. And we're going to start with top down. Notice today we have 3,757 stocks. That means that the NASDAQ plus the NYSE plus the AMX filtered at $1 and 100,000 shares is at 3757. That's at a high number. I've seen it in the 35s. I've seen it approach 4,000, but that's a pretty decent sized number. So when we look at the stocks here, the way we've elected to do it, let's pick something. I don't know. The way we elected to do this, I hit the wrong button, is all right, Jeffrey, what am I looking at? Let me just type in something. Every stock in our data set has a sector and an industry group. So unlike the S&P 500, and let's just look at the SPY. In fact, let's look at the SPY versus the RSP. This is new. Create the ratio chart on the fly. It'll take a second to calculate. That tells me right now, massively, straight up, the spider is outperforming the RSP. Why did I show you that? Because if the S&P 500 sectors are based upon that performance, and my sectors are based upon that performance, which isn't bad, but notice it's below the 50, then the makeup of the leading sectors is going to be totally different, because I'm not looking at 500 stocks, I'm looking at 3,700. So let's just go into the top down, and we could see that Friday was a stronger day, and we got a lot of strength. Communications, energy, and tech were the big movers on the broader markets. Now that's different than in the daily briefing where the top three were. Let me go. So Praveen, you're here. Please see if you can make the default to be best fit all columns, because that's what happens. But if I do that, it looks a whole lot better. So when we looked at 1 day change, I screwed myself up by doing that. Let's do that again. If we look at 1 day change, in the 500, it's discretionary, energy, and communications. So I'm going to stay with the program, and I'm going to stay with the broader markets, and these were the three on the broader markets. Then these are the industry groups that come out of those top three, and I'm going to rank them by percentage. And I got asset management, solar, coal, electric, internet, oil, gas, software, oil and gas, and hardware. And these would be the top 10 industry group performance on a very broad index out of the top three sectors, top 10 industry groups. That gives me 631. I always filter at $5 and 500. That's just me. Let's say you don't want those. I'll show you at some point how you can do that yourself. You can actually see down here what these filters are. So technically, you could be coming in here and saying, I don't want 500, I want a million. And you can come in here and you could adjust that yourself. Okay. So now we're sitting here with 366 stocks, and I might look at them by percent performance, but I'm going to get things that look like this well, this one looks actually interesting, but I'm typically going to see things that look like this, big moves. Don't know this company forever. It's a technology play. Make sure I'm on the daily because sometimes I forget and I'm sitting on the weekly. So for some reason, the stock had a big run, sell off, back down to the 50. A lot of story stocks do that. So I'll open up, look at earnings. Earnings are not out to November 10th. It loses money, no dividend, losing interest. Um, founding member of board. I don't. I might want to know what this company does. Capital structure. Nothing there moves my needle. What I did want to show you that this is tells you what they do. Not helpful. Highlight it. Very helpful. So it's a Bitcoin holding company, digital assets, subsidiary of ICE. Well, all of a sudden, I'm now getting more interested. So I guess it might move with Bitcoin. So I love the pullback to the 50. It's not above the moving average here on the relative strength, so I'm going to skip that one. Twillo. And that looks like an earnings story. Let's see. Earnings came out the 30th, 16% surprise, and a 3.8. Why do we put surprise in there? I believe that I'm a technical guy, and I believe the chart reflects what all the people in the market think the price should be based upon all the fundamentals. And I believe it's surprises, expectation breakers that lead to big moves like that. A 16% surprise on earnings. Now, we don't have forward in here because we have forward, but I don't know if that was increased or not. So I can't say that they have a triple play. So you had a big surprise on earnings, surprise on revenue, nice name long term. Okay, it's not the one I'm going to pick. STEM, no. CSIQ. Solar's hot right now, and this is one of the lower cost solar stocks. Earnings are November 13th. It doesn't make money. Um, I'm only going to pay attention to that one because of this one. First Solar is in a beautiful uptrend. Earnings came out on the 30th, and interestingly, they didn't surprise, but I think look at the growth turnaround play here. 45% earnings per share growth, multiples 12. If that can keep it up, they're looking at 554 February 24th, going against 365. That's a 50% growth. I may need to come back and look at this. I've owned it before. So First Solar looks interesting. I skipped DGNX intentionally, and I would go down this list, OSIS systems. This one looks interesting. Cloudflare is one. I know we use it in our cloud assets. So I'm already finding a few stocks that look interesting just by using this search. Now, this is heavily tied to one day because it's looking at percent change. All right. What if I look at something that's a little bit more than one day? What comes up? OSIS, when we just looked at. So did earnings come out? Earnings came out, little surprise on earnings, negative on revenue, 253 coming against 242. Not much in the way of growth. Um, and if I want to know what they did, I would just highlight that. And we used to have this, but I couldn't use it because of the way that it was formatted. But that's a big improvement. .NET, First Solar, Twillo, AppFolio had a, and this had to be an earnings reinterpretation. Open lower after earnings, closed much higher. That's a belt hold candlestick. That's a really bullish candlestick. Notice the relative strength and OBV picked up. Got to get above the 50. It's an expensive stock. 134 is going to be against 92. That's 40 cents. That's a big, that's a, or 50, yeah, 42 cents. Big earnings growth coming in. I love this candle. This candle says we got it wrong and reevaluated, and people, I like that candle. And relative strength crossed over. We've got momentum, breakout, volume. Why the gap is red, your guess is as good as mine. Um, typically, the gap up is not going to be red. CPR fired. All right, that's interesting. Hubs was one that I looked at last night. It's well below the 200, which is not typically my favorite, but relative strength and OBV we're crossing. Um, this is the one I think we should work up, DDOG. And this is one of my favorites of the charts I looked at. Unlike some of the ones we just looked at, it's in an uptrend. Unlike some of the ones we looked at, earnings are coming this week, and that's a concern. But since this is for hypothetical purposes, I don't mind working this up. I like it. It broke out of a little of a downward trend line. It did it back here. It had a big move. It's coming out of a squeeze. It's got momentum volume, momentum breakout volume of CPR, and the EMS also flipped, relative strengths above, and it looks like um, OBV is above as well. You know, one thing, Praveen, that we could do, maybe, I know we've talked before about um, putting a signal in. Could you put an arrow or a dot, green dot if green's above yellow, if white's above yellow, an arrow up so we know that they're above. Sometimes it's hard to see. So I go down. That's another way I like to go down. MicroStrategy, there's that CSIQ again. MicroStrategy, no. Um, this one used to have a big premium to their holdings, their premium. Um, huh, yes, I'm just laughing because I just looked at a note. Um, so the premium is gone away, so it might be a decent way. Somebody asked a question. Leading sectors sorted by last 5 days too. You do have 5 day momentum, so that's going to get close to 5 days. But we actually just built something into the program that's not on this view. And let me show you that as we switch back to the bottoms up perspective. Go back to impulse. You will be able to reset this. I haven't played with it, so I'm not going to play with it now. Back how many days you want to look to what the results look like on a given date. It's going to be a great tool for teaching, a really great tool for teaching. So I'm excited about that. I think we're going to end up putting a calendar and give you, is it 60 days? Is it 90 days? Can we go back longer? Yeah, that Bazi, that's why I went to the 2 day, because you get rid of it. You could also look at the 5 day. That's exactly correct. But I think it's going to be a great for teaching. So we're back in the big data set. Let's clear the filters. And in the bigger data set here, we still must have a filter on, or I went to the wrong place. Let's try this again. All right, now I got to figure out what did I do here. All right, let's go back to impulse. All right, so typically, if I don't see what I think I'm supposed to see, it's me, not the program. Praveen, why am I only seeing, I'm going to stop the internet video. Oh, no, leave it on. Why am I only seeing 627 stocks there? Turn off these filters. It's almost as if I flipped. Okay, I must have flipped the data set. All right, let me now go back to impulse and go back to base. All right, we're back. All right, I must have hit one of the stock lists because we're now back to the 37. Just to remind everybody, we put in 2 scans of our best stocks. A plus, it requires the double, let's look at one, put Bausch and Lom's up, the double momentum signal, which is right here. You can see it had a really big day on Thursday, followed through momentum on Friday. It doesn't look like much, but it came up on a bunch of my screens. It had a surprise on earnings, which is good. Really negative surprise on revenue, which isn't so good. Does it look better on a weekly? No, it's been dead forever. So it made my scan. I looked at it. It's not the most beautiful chart, but it's funny. It showed up on a bunch of my scans. CNX, which is resources, I think they have coal. Um, Again, not a beautiful looking uptrend, short-term uptrend. Alumina had a big breakout. Now this is probably a better looking story. The question is, what's the high jump? It's hard to buy things where the high jump is 100. And I know I often say I'll ignore it if it's real close to the 200. It's been going sideways, and maybe I will ignore that, but it does increase the risk some. This had a 25% move. Keysight also looks interesting and not at the top of the high jump. We can see up here earnings are in a couple of weeks, so take that as important. It's in an uptrend and a breakout. Crystal Biotech, big run, pullback, looks like it's ready to run again, an expensive stock. LCI Industries, don't know what they do. UMC, United Microsystems, and XPO Logistics were the ones that had the double momentums. This one does look interesting. Um, let's kill that one. And let's take a look at what we got here. We got a couple of things I'd say here. I'd throw in a horizontal that we're breaking out there. Was resistance there. I mean, that to me might be all it takes. High jump is not above 95. It is. That would be concerning. But this one, unlike Illumina, is not 20 some percent away from its 200. So this is one I might consider as well. The other of my favorite scans is the A. This one is more traditional, what I've looked at, which has been stocks that are pulling back in, or that are in an uptrend. Some of them have pulled back, and they have, here's your pullback, obvious pullback, big volume, relative strength's got to be above the moving average, as is OBV, and they have to be in a squeeze or coming out of a squeeze. Squeeze is the yellow line, either the momentum or the breakout line, and that's where I found Datadog. So that's going to be the stock that we're going to work up as we go forward. To those of you who are joining us on YouTube, I must bid adieu because the options thing I'm doing just for the folks that came to my class. So for the people online, let's take about a 3-minute break so I could stop the recordings and separate the two. And we will continue in a few minutes with a workup of Datadog and some talk about options and see if I can't find a decent trade to take on Monday. So thank you all for being here. Special thanks to my friends who are live. I'm going to pause it and we'll be back momentarily. Pause recording. Actually, I'm going to stop that recording and do it twice.